Hello traders, Gary Wagner here. Approximately 10:30 in Honolulu. It is the 19th day of October, 2012 on Friday, and this is the daily report for gold and silver. And what a week we've had. Thank God it's Friday. Sharply lower prices across the board in the metals market, specifically when we take a look at gold, currently trading off about $21 on the day. As you can see, 1720.88 current print. Low has been 1714.20 with a high of 1740 and change. Silver also down sharply today. You can see this incredibly drastic low. That low is sitting at around 31.83. As you can see, 31.82 is our 50% Fibonacci retracement. We'll talk about that later on in the show. Current print, 32.04, puts it down about 75 cents on the day, almost 2.5% lower. As I said, the low is 32.88, and the high today, that was the high, 32.88, excuse me, and the low, 31.83. Of course, the question today is absolutely how low can it go? I'm speaking about, of course, both gold and silver. And on today's report, our weekend review, I will work as hard as I can to try to answer that question for you, looking at technical evidence and technical historical data or reference points to give us some sort of insight or clue as to where we think the market might go. The first thing is we talked about a fairly critical level, and the level that I was speaking about was really at around 1739. When we broke through that, it put us into really a tumble or a free fall. As you can see, and the market came down about 20 plus dollars on the day, has been lower throughout the week. Couple of things are significant. The first thing is we know we've got incredible historical precedents at this point for this $1,800 mark. I'm going to try and line it up. You can see this is just shy of that, but 1,800 absolutely superlative resistance. 1560 absolute superlative support. So we're still within this range. That's the first thing that we're noticing. What we want to see, of course, to really let us know that we're going on to new highs, it's first got to break above these recent tops, this $1,800 mark. Now, that being said, what are the different levels and targets that we want to look for? And for that, I want to really go to a much shorter term chart. We are looking at a 360-minute chart. It's in Japanese average or Henkin format. I will convert it into a candlestick chart, time permitting, because there's quite a few charts I do want to look at today. But here are the various levels that we want to pay some real attention to. My daily subscribers know we've been looking at this throughout the week, but when we take a look at this chart, when we start really, we're starting back, August 30th, up to this top here, which is just shy of 1,800. We're starting at about 1640, 1643 as a mark. When we take a look at the various marks, we can see that they absolutely have some effect on the market. When I say effect, I'm saying that in these areas, we see interesting price activity, such as this market moves up, you can see a true band of resistance just below the 61% level. This, of course, is sitting at around 1701, pretty critical area, and it's critical area for another Fibonacci chart. We'll talk about that in a second. You can see that as the market pops up, it really pops through the 50%, but it certainly stalls right here. This is the 38%, 1737. That was an area that I had talked about being critical throughout the week, and we'll explain in a little bit why I still feel that way. And then lastly, 1760, 1759, and this, of course, is our 23% level. Now, when we take a look at it, we can see that as the market pops up, it pops above this 23% level. Now, even though it trades in very, very slightly, you can still claim and have pretty good historical backing or reference that this price point was pretty supportive. When the market then fell down and fell through that resistance area, you can see the next supportive point was our next Fibonacci retracement level, this being the 38% at 1737. Market comes back up. You see supportive price activity, of course. Again, supportive price activity. Market tries to really generate some steam, move to the upside, but it absolutely fails. There's no doubt. And you can see really the size of the Henkin candles are illustrating the strength of that sell-off here. You get a small little blip up, but it can't even make it to that resistance area. But look at this, traders. When the market breaks through this 1737, and this is what I was trying to talk about in a second, look at the sheer size of this candle. Look at the low that it made and compare that to these other candles, these Henkin candles here. And without a doubt, except for a couple other periods in time, you can see a few other candles here and also here where the market genuinely got washed out, that we had that kind of range. It's also interesting when we look at it in that way at the following, and that is when we had these types of Henkin candles. The type I'm referring to is right here, where you do get the lower wick, but you get these extreme tails, such as right here, and such as this price activity right here. What it was indicative, really, of the bottom, the market, a tentative bottom, I should say, not absolute bottom, but you can see that these extreme lows kind of washed out. I look at it as they went hunting for stops. They cleared the board, so to speak, and then pushed the market back up. We've got an interesting activity again because, once again, even though the market's sitting by the lows, 21, you can see this extreme low in the market. And that's why it's important not only to look at this chart through the eyes of a Henkin chart, but to convert it to a candlestick chart. And let's go ahead and do that right now. As you can see, in some cases, and especially now, you can see where it makes all the difference in the world to take a look at it through a straight candlestick, open, low, high, and close chart, because what you're seeing is, even though the low was into and below this 1718 area right in here, it has tentatively, we're at about 11 o'clock Honolulu time, so the market has closed at this point for the weekend, but you can absolutely see that it managed to close just above it. We had supportive activity here and supportive activity here. We'll have to see. It's quite early to tell, and my sense is, as we'll talk through this show, that we've got a really important point, and that point, of course, is our 61% retracement and our 76. Now, my personal sentiment, first of all, and I talked about this all week, is if we see continued selling pressure, I would look for the market to find support just above $1,700. I think that is a very, very strong point. It also is indicative of the fact when we run our Fibonacci retracement, as I said, from this low right in here, the 61% retracement, of course, takes us to 1,700. Very, very critical number. And so I think that if we do have continued selling next week, and my personal sense is that it is likely that we will see that. If in fact we do see that, this is where I would look for support in the marketplace. Now, to further illustrate my cause, let's move back out in time from these intraday charts. And as you can see, a short-term chart for me is 360 minutes into the daily and weekly charts. We are looking at a daily chart, continuous contract. This is of COMEX Gold, of course. I have entered 3 different Fibonacci ratios from 3 different points. They all start from the same, well, excuse me. The longest one starts, of course, way down at the beginning of this rally, 700. They don't all start at the same point. This at almost 1,200, 1179, our interim. And then our short term starts here at around 1325. They all do end or terminate at the top. Now, what we look for, and we've talked about this before, it's something simply known as Fibonacci harmonics. And what we try to accomplish with a Fibonacci harmonics is to look for different Fibonacci sequence times, such as these three, and we look for areas that we have agreement on. In other words, where you have a very close or the same Fibonacci number, it's going to be, of course, a different percentage, but it should point out a critical area in the market. With that in mind, let's take a look at this, because there's two really, really strong areas. You can see that 38%, 1647, 50%, 1631. You see how close these are together. This then becomes a very, very strong and dominant, important Fibonacci number right now. When we look at it, you can see that it also corresponds to where the market broke out. This is where we got long initially. Very, very critical area. Now, look at this area, 38%, 1469, 1466. That's very strong because you get two there. And then there's one other place that we have something that's pretty close, not exact, but pretty close, 1757, 1792. That's these two. So we get a critical area in here. Now, that being said, my sense is that this should be absolute support in the marketplace. As I said, I personally think that 1700 should hold. That's this particular fib number right in here, 1703. It is a 38% retracement level. You can see that we're fairly close to it. We're at 21, so we're not all that far off. I'll go ahead and blow that up in a second so you get a better sense for it. And we still have really strong resistance of Fibonacci harmonics is existing right up here at around 1800, 1757, these two areas. So those are areas in terms of long-term perspective that we absolutely want to look at. Now, let's go ahead and blow this up and so you'll get a better idea of what we're looking at, and I also want to convert this into our average chart. And what we can see, and let's go ahead and convert this to the Henkin chart, 1 second. And it's really because, especially on the continuous contract in the COMEX, it gives us a much better viewpoint, I think, because it takes the noise out. And once again, on our daily, I think that this is an extremely critical area. Now that we broke through the 39, our next real level that we want to look at to see what the market can do is going to be right here, 1700. Now, do we have any kind of historical reference points recently that can kind of line up with that? Well, you can see this series right here. It's very, very supportive. You really don't get any information. You get a little bit of a glitch here. You get it to be resistance here, but it's not very, very strong. Comes here, you get this very, very strong area, and that's what we talked about in terms of the actual fib harmonics as the market comes up. Of course, 1800, real resistance. And so the question is going to remain, if in fact this market does continue to trade lower, which I believe it has a likelihood of doing over next week, the real question is, how will it react at this area? Because I truly believe that if we get the proper indications that this is going to be a really nice, strong area to enter the market from. Another way we want to look at our daily before we go to our final weekly gold chart and then move on to silver is this. And in this particular chart, we have put some Fibonacci retracement areas. We also have our current Elliott wave count. Our wave count showing in this case for the most recent activity, we are looking at this is our major count. We are in our major fifth. This is our major fourth right here. And this, of course, is a long third, major third. There's no doubt we had our correction. And I have relabeled it because I believe even though we had this corrective triangle, since we didn't have that final fifth leg, we can easily see as the market comes down an A, B, C correction. Market moves up. This is wave one, intermediate. We are currently in corrective wave, intermediate two. Our daily viewers know that we then break that up into our minor and sub-minor count, but for the weekend review, we'll just keep it at this. You can also see 1699. 38% retracement level, very strong. And then another very strong Fibonacci harmonics, 1627, 1634. And of course, once again, that's that harmonics that got us long after we had this breakout and the market had been trading in this highly, very narrow range right in here. You can see that breakout above that. and you've got, of course, the Fibonacci harmonics. Lastly, I want to take a look at a couple of weekly charts very, very quickly. I know this is an extended program. We have a lot to cover, but I do want to cover it as quickly as possible. You can see, no doubt, we had this doji here. We're gone to red. There's no doubt we have hit the very, very top of the market on an interim basis. There's no doubt we have hit resistance and are probably headed lower. When we bring in our weekly chart, that gives us some new information. First of all, this is in candlestick format, and it gives us some different information. And I also have some fib numbers that we'll look at, and you'll see that they pretty much line up with the other ones that we looked at. But here's what you can take out of this chart, traders. When we take a look at this market, it comes up, this is that beautiful ascent. 1 week doji, 2nd week doji. This week, almost a shooting star. Now, for it to be a shooting star, of course, it would have a tail that's a little bit longer than the tail that we see right in here. But nonetheless, it's shooting star-esque, I should say. That's engulfed by a down week. Last week, this is this current candle. So you get an engulfing bearish, and this week is your confirming candle to the engulfing bearish, which tells you that there is a likelihood that we'll see lower pricing. On a weekly chart, of course, our next level is still that 1700, but on a weekly chart, it appears as though the retracement could be deeper than originally perceived because it's just begun. You had this absolute top here. If it does not hold in this first area, this is that 1700 area, the next real level is 1663 and 1632. 1632, again, absolute support. We've talked about that. There is no possibility, in my opinion, of the market trading that low. If, in fact, it broke below 1700, the next level we would look at would be 1663. But traders, I'm still fairly confident that 1700 should hold. We'll have to see if the market proves me wrong. As we look at the silver market, our first chart, a 420-minute chart, straight Henkin format, Japanese average format, intraday chart, continuous contract, COMEX silver. We can see the kind of sell-off that we witnessed was really, in terms of percentage of retracement, much, much stronger than gold. It typically is. On the upside, we've seen greater gains. On the downside, we've seen greater losses. Now, the question remains, has it found support? Will it trade lower? I think that it's going to follow suit with gold. So we'll have to use gold kind of as our leading indicator and know that if the gold market is under pressure and remains under pressure next week, we should expect really the same thing to happen with silver. It's at an area right now, this is 3190. It's a pretty critical area, and let me show you where I derived this from. I'm going to have to really go ahead and compress this chart to give you an idea of what we're looking at. Let me go ahead and do that. There we go. As you can see, I have put a couple of different retracement points, 2 major points. One retracement point begins really as the market was just at about $38 and takes us to $26. That, and then our secondary retracement begins really at about, call it 27 and change, and takes us to the secondary top. With that in mind, we can see that as this marketplace began to sell off, we can see that it has, at least on a tentative basis today, found some sort of support just above $32 per ounce. The question remains, where could this market continue to trade lower to? And my sense is right now that what we want to look at, and let me go ahead and move these numbers to the other side so it's a little bit easier to read. Just as in the gold market, we have a pretty critical area, I think it's 1700 that should hold. I think that in terms of silver, there's nothing really as cut and dry, really, until we get below really $30. And what I'm talking about is this particular top right here, as you can see, is just below $30. It comes close to its no definite match to our fib retracement point right in here. But you can see that this is where the market failed to move higher after it came off of this low. Our real levels, 31.47. This is a 51% short-term, 3190 is our 51% longer term. So you've got these two 50% retracement levels. That's an area we want to watch. If it cannot hold this area, our next real level that we want to look at is going to be around $30.53. Call it $30, $30.50. And then absolute support, I believe in silver, if it falls under more pressure than we anticipate, is going to be just above $30 per ounce. I think it should be able to hold there. These are the different areas that we want to look at. Pay specific attention right in this area at 31 to see if that holds, and that would be just in this area, 50% retracement, 31.47. This has been Gary Wagner, wishing you as always good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.